Welcome to The Explainer. Today, we are going to break down one of the most fundamental tools in all of finance, the moving average. Seriously, it's the simple idea behind so many complex trading systems, and by the end of this, you are going to get it completely. So, if you've ever looked at a stock chart, you know exactly what this is, right? It's just a chaotic mess of ups and downs, all those daily price swings. Traders have a name for this, they call it noise. And trying to figure out where the market is really headed just by looking at this? Yeah, it can feel pretty much impossible. But what if I told you there's a simple, really elegant tool designed to cut right through all that static? One that can reveal the actual story the market is trying to tell us. Well, guess what? There is. Here's the best way to think about it. Imagine the daily price swings are just wrinkles and creases on a crumpled up piece of paper. Our goal is to smooth out those wrinkles so we can actually read the message, the real trend that's written underneath all that mess. So, what is this magical tool? What do we use to smooth out all that market noise? Well, it's called the moving average. At its heart, a moving average is exactly what it sounds like. It's just an average price, but over a specific period of time. Now, the key word here is moving. Why? Because with each new day, a new price gets added to the calculation, and the oldest one gets dropped. So the average literally moves right along with the market. Okay, let's make this super simple. Say you want a 10-day moving average. You just add up the closing prices for the last 10 days and divide by 10. Easy. Then tomorrow you do it again, but this time you add the newest closing price and you drop off the one from 11 days ago. And that's it. That's how the line on the chart gets drawn, one point at a time, creating that nice, smooth, flowing indicator. And here is the big payoff. Remember that crazy, messy chart from the beginning? This is the exact same chart that, look, we've drawn a 10-day moving average line right over it. And just like that, boom, the jagged noise just fades away, and that underlying uptrend becomes crystal clear. Now, here's where it gets interesting. The power of a moving average really comes down to one crucial choice you have to make: the time period. You see, the number of days you decide to include in your average totally changes what you see on the chart. And this slide just shows that perfectly. Check out the 20-day average. See how it hugs the price really closely? It's super sensitive, which is great for a short-term trader. But then look at the 200-day average. A lot of long-term investors watch this one. It's way smoother, right? It just ignores all the little bumps to show you the major long-term direction. And that right there is the big trade-off. Do you want sensitivity or do you want smoothness? And it's not just about the number of days either. There are actually different flavors of moving averages. The two most popular are the simple moving average, the SMA, which basically treats every single day in the period equally. And then there's the exponential moving average, the EMA, which gives more weight to the most recent prices. That makes it react a lot faster to new information. And wow, you can really see the difference right here. Look at that. As the price starts to take off, that dotted exponential line, the one that's more sensitive, it starts to turn up before the solid, simple average line does. And that quicker reaction time is exactly why some traders swear by the EMA. Okay, so we've got these cool lines on a chart that show us the trend. That's great, but so what? How do we actually turn these lines into something useful like, I don't know, actual buy or sell signals? Well, let's start with level 1. The most basic method is called the price cross. And just like the name suggests, it's all about watching how the price itself interacts with that single moving average line. The logic here is really straightforward. Take a look at this chart. When the price bars cross below the 50-day average, that's seen as a sell signal. And when the price climbs back above that line, hey, that's a buy signal. It's about as simple a rule for following a trend as you can get. Now, here's the catch with that simple method. It can give you a lot of false alarms, especially when the market is just kind of bouncing around. So, to filter out some of that noise, a lot of traders use a more advanced technique. Let's call it level 2, the double crossover. So with this method, we're not just watching the price anymore. We're watching the relationship between two different averages, a fast one and a slow one. So, in this example, you get a sell signal when the faster 10-day average crosses below the slower 50-day. The buy signal? That comes when the fast one crosses back above the slow one. You're basically waiting for the short-term trend to confirm that the longer-term trend is changing too. But wait, there's more. Moving averages can do more than just help you follow a trend. They can also help us spot market extremes. You know, those times when a price has moved way too far, way too fast, and might be ready to snap back. Two really popular tools for this are envelopes and Bollinger Bands. Now, on the left, you've got moving average envelopes. Those are just bands drawn at a fixed percentage, like, say, 3% above and below the average line. On the right, you have Bollinger Bands. They look pretty similar, right? But they have one absolutely critical difference. And that difference, in one word, is volatility. You see, unlike those fixed envelopes, Bollinger Bands automatically adjust. They expand and contract based on how choppy the market has been lately. So when things get wild, the bands get wider. And when the market is calm, the bands tighten up. This adaptability, well, that's their superpower. And this chart just shows you how powerful that can be. When the price hits the upper band, it can signal that things are getting too high. But look here, every single time the price on this chart fell and just touched that lower band, it signaled that the market was oversold. It marked a huge market bottom and, potentially, an incredible buying opportunity. Okay, reality check time. As powerful as moving averages are, it is so crucial to remember they are not a magic bullet. They're not perfect. In fact, they come with a really significant catch. This quote really says it all. As trend-following tools, moving averages are amazing when there's a clear trend to follow. But when the market isn't really going anywhere, when it's just chopping back and forth in a sideways mess, these systems can get you whipsawed, generating one false signal after another. It's their kryptonite. All right, so let's wrap this all up. What did we learn? First, moving averages smooth out all that price chaos to show you the real trend. But, and this is a big but, they are lagging indicators. They follow, they don't lead. Remember the trade-off. Shorter averages are fast but noisy. Longer averages are smooth but slow. And their absolute biggest weakness is a market that's just going sideways. And all of this leaves us with a really fundamental question, one that every single trader has to answer for themselves. It's the essential trade-off we've been talking about this whole time. When you're trying to make sense of the markets, what do you value more? Reacting faster or being right more often?